And now for a look across the local market today, I spoke to Simon Robinson from Wilson HTM. Simon Robinson, a pretty unconvincing rally today. Is that how you saw it?
Yes, Ticky, that's right. You've got to remember that the US market has been up 8% this month, driven off the back of a pretty good results season, whereby 75% of the US companies have basically exceeded their guidance in terms of an EPS sense. So that's been very good, and the Australian market's up 7%. I think, though, we probably have our reporting season ahead of us, and the market will take a bit of a breather here for a consolidation period.
Property developer Australand has more than doubled its half-year profits. Were investors impressed?
They were, Ticky, and I mean, it's good to see that Australand, it was coming off a low base, obviously, when you do double your profit like that, but it reaffirmed its guidance. That's a positive for the market. We also know that through the global financial crisis, property stocks really took a battering. Australand's balance sheet looks to be in a solid position. It's paying a good dividend. It's reaffirmed its guidance, and it's expecting earnings growth next year. Properties are a bellwether for the economy, and when we see improved property valuations, that brings further confidence to investors' minds just generally.
And now in mining, Centennial Coal has put out its latest production numbers. Do they reveal what's making the sector so attractive to overseas investors?
Yes, indeed. I mean, you've got Centennial, the subject of that $6.20 bid from Banpu. The international players, Ticky, really understand the value of Australian resource companies, and in particular the coal sector. The world is short energy. We've seen, this takeover being made for Centennial. Its production is very strong, so it's got a good source of supply for overseas markets. The overseas markets understand that. And let's not forget, you've had, with these takeovers, you've got fewer and fewer independent coal-based companies listed in Australia, which, really highlights the value that the international market's putting on our coal companies.
And the Australian dollar holding above US 90 cents today. What's that done to import-export stocks?
Yes, well, it's good for import stocks, but we've got to be very careful. I mean, it's creating a real headache for Australian companies with huge overseas foreign exchange exposure, because you've had the Aussie dollar move 7%, sort of from 84 to in excess of 90 cents in a matter of this month alone. Those sort of gyrations make it very hard for companies with large overseas earnings exposures to hedge effectively. And we did see when the Aussie was on its way to parity at some stage over the last 12 months, a number of companies come out with profit warnings which were exchange related. So certainly a tricky time for companies with large overseas earnings exposure. Ticky.
Simon Robinson, thank you very much for talking to Lateline Business.
Thank you.